Let me show you how to use divergences to find the best trading opportunities on any price chart and any time frame. So what is a divergence? A divergence is when the price action and the indicator are not agreeing, when they're showing you two different things. And we can see that in an example here. So I am using the MACD, the basic settings 12.26.9. I did a previous video as well about RSI divergences. You can search for that in my YouTube channel as well. It works pretty much exactly the same. And what you want to look for is when the market, for example, is making a higher high, like in this case, and the indicator is showing you the exact opposite thing, which is a lower high. Now the indicator and the price action are not agreeing and they are diverging. That's where the name is coming from. In a different example here previously, the market was making lower highs or lower lows in this example because it was a downtrend. And you can see when we connect the peaks with this MACD, it's very easy because the peaks are always drawn or colored very dark. And you can see in this case, the MACD was making lower lows when we take a look at the red lows. And here the price action was making lower lows as well. So this was not a divergence. But here we do have a divergence. What does it mean? It means that although the price action was showing you that the trend was up because the price made higher highs and moved higher, the MACD looks deeper into price action. And this is really where the indicators have a great benefit, because indicators are often more detail oriented than the trader. The trader just looks at the price chart and looks at, okay, the price making higher highs, I guess this means the market is up. But the indicator actually looks at many more data points. It looks at the open, the low, how does the open and the low and the high compare to the previous lows. It looks at different candle sizes. It looks at different candle ranges. And this is where the indicators are actually very helpful, because they look at and they perform very in-depth calculations, much more than what traders do when they just look at price charts. So don't dismiss indicators. They are actually great tools if you know how to use them. So you can see the MACD shows you a divergence. It shows you that here the MACD was much lower than here, which means that overall the momentum was not really up. The momentum was actually fading, which means that the uptrend here in this example was losing strength. And very important to note that. And this means it's a heads up that, okay, there's not actually that much buying pressure in the market, and you should get ready for a potential reversal, which happened here afterwards. You can see the market completely fell through the roof and completely tanked after this divergence. And then the market and the indicator were agreeing. You can see the market was making lower lows, the MACD was making lower lows. And then we can follow the MACD actually. Let's take a look. And what happens here is that at one point, although the price action was moving lower, here you can see when we connect, whoops, let me move that a bit. When we connect this low here, for example, with where this is happening, so right around here, you can see again that the market and the indicator are not agreeing. Here the price was making lower lows. Here the indicator was not even going red again, so it was already showing you that this downtrend here is very likely to be over at this point. And this is exactly what happened. You can see the market bottomed out. It started a completely new rally here afterwards. So you can see this. The MACD would have warned you already that, all right, so now it's not the time to look for more short setups. It's time to either get out of the short setup after divergence or maybe even look for buying opportunities. And this is how you would use the MACD divergence, and the RSI is very similar. Let's take a look at a few more examples. And another important point is that you always want to look for a trending market when you look for an indicator, because for divergence, because that's where divergences are only really meaningful when you look at an established market, you want to look for when is the divergence coming up. And we can look at here, for example, there was a trend going on, then the market was making lower trends, lower trend waves and lower lows. Let me move that again. But the market was already giving you one divergence here. However, the market never really turned around and the market kept going lower. Very important. If a divergence happens, it doesn't automatically mean that the market is going to reverse. It's just a first heads up. And a divergence alone is not enough to call a reversal. You want to see that the market is actually also making a higher high point. So in this example, the market was always making lower highs. Very, very important. And then here there was a second divergence. So actually a double. Let me try to zoom in here. Whoops. All right, this is getting... All right, so here we go. So here we actually do have a double divergence. When I connect the lows here of the MACD, you can see the MACD was making higher lows. And when we look here at the price action, we see lower lows. So although the price action was indicating that there is a downtrend, which is still ongoing, the MACD looked deeper. Again, the MACD looks much, much deeper in the price action than what most traders are capable of. So the MACD was telling you, okay, the market is actually slowing down. The downtrend is not as strong anymore. And then shortly afterwards, you can see the market broke the previous high. Now it's the first time that the market actually made a higher high, whereas previously there was only lower highs. And then it completely reversed and took and completely started a new uptrend after the divergence. So this is how you put things more into context and how you can use a divergence on a deeper level. Let's take a look at maybe two more chart examples. So let's start here. By the way, I've shown you so far the daily chart, a 12-hour chart, and now it's the 2-hour chart. You can use divergences across all time frames. It really matters only what you're comfortable with. And again, we're looking for a trending phase, very strong trend. And then here the trend more or less topped out. And at the same time, you can see here we have a huge divergence and a huge disagreement between the price action, which was always showing you higher highs, and the MACD, which was already completely flattening out and completely going to the zero line, so almost showing you no momentum at all. So the MACD already shows you that here we don't have any momentum anymore in the market. The market pretty much ever since here slowed down and lost its momentum, and exactly what happened. You can see the market then rolled over, started a new downtrend. And what happens then is that we connect the lows. You can see the market was making lower lows and the MACD was giving you higher lows. And the second divergence. So whereas here it's not a textbook divergence because the market is making a double top, you can still see that the price action and the MACD were disagreeing. The MACD was showing you a huge loss in momentum, whereas your price action was first showing you still a trend and then a double top, not a lower high. And then here a complete divergence where you can see, okay, lower lows and then here higher lows on the MACD. A very big disagreement again. The market then topped out. You can see here is, by the way, the first time the market made a lower low. Here is then the first time the market made a higher high. So you can see it doesn't take a lot. You can put a few pieces together of the puzzle. You use divergences, you look at market structures, highs and lows, and then you can already make sophisticated chart analyses on your price charts with just a basic MACD indicator. And you don't need to get fancy. The standard settings work really, really well for divergences and for understanding market dynamics in this way. Let's take a final look at gold. So previously I've only shown you Forex pairs, but you can also use divergences on any commodity or CFDs as well. And again, we want to start with a trending market, and then you want to look for, okay, when is the price action and the indicator disagreeing? And here you can actually see a huge divergence. You can see ever since here was pretty much the starting point of the trend, and the trend was very strong, but afterwards the trend slowed down. You have larger consolidation and correction phases, and this is what leads your MACD to show you a divergence, and what a huge divergence. Every time there was a peak indicated by the dark red, you can see that it was a already a divergence. But it wasn't until really the market made a bigger turnaround. You can see roughly around here you have a pin bar signal, a failed breakout to the downside, and then the market rolled over. In this case, the market did not make a huge reversal, but you can see the previous downtrend was over, and you did have a push into new highs here. So again, a divergence is really a powerful tool. Make sure to always use it only with established trends. The longer the trend, and then once you have a long trend and a divergence, the stronger the signal usually is. Double divergences or triple divergences can be really great as well, and wait for the market to break a previous high or low point if you want to time your trades. And then you can use divergences on any time frame in any market and trade much more reliable setups.